There's a stretch of roughly 8 years sitting in the middle of most people's retirement that quietly determines how much tax they will pay for the rest of their lives. 8 years. And the overwhelming majority of retirees pass straight through it without doing a single thing differently, because nothing about it announces itself. No letter arrives, no deadline passes, no penalty gets assessed. It is the only period in the entire arc of a person's financial life where they have almost complete control over how much taxable income they report in a given year, and it ends without warning, replaced by a set of rules that takes that control away permanently. The retirees who handle this window well, and the retirees who ignore it entirely, often have identical account balances, identical savings habits, and identical incomes throughout their working years. They did the same things. They saved the same amounts, and they end up paying dramatically different lifetime tax bills. Not because one of them earned more or invested better, but purely because of which calendar years they chose to move money in. Same money, same accounts, completely different outcome. That's what makes this the purest version of a decision that costs nothing to get right and a great deal to get wrong. So let's start with why this window exists at all. Because understanding the mechanics is what makes everything else make sense. When someone contributes to a traditional 401k or a traditional IRA during their working years, they get a tax deduction in exchange. That money goes in untaxed, grows untaxed, and stays untaxed for as long as it sits there. That's the deal, and it's a genuinely good one while it's running. But it was never a tax exemption. It was a tax deferral, a postponement. The government allowed that money to grow untouched on the understanding that it would eventually be taxed on the way out, and to make absolutely certain that day arrives, the tax code includes a mechanism called a required minimum distribution. A required minimum distribution is exactly what it sounds like. Once a retiree reaches a specific age, they are legally obligated to withdraw a calculated percentage from their traditional retirement accounts every single year, whether they need the money or not, whether they want the money or not, and whether the market is up or down that year. There is no opting out. The penalty for skipping one is severe, and critically, every dollar pulled out under that requirement counts as ordinary taxable income in the year it's withdrawn. The age at which this begins has moved several times over the past few years, and where you land depends entirely on your birth year. For anyone born between 1951 and 1959, required minimum distributions begin in the year they turn 73. For anyone born in 1960 or later, that age moves out to 75. Hold on to that second number because it matters enormously and we'll come back to it. Now put those two facts side by side and the window appears on its own. A person who stops working at 65 and doesn't have to take a required distribution until 73 has 8 full calendar years in between. 8 years where they are no longer earning a salary, which means their income has dropped substantially, possibly to the lowest level it has been since they were in their 20s. And 8 years before the tax code starts forcing income back onto their return, whether they want it or not. That gap between the last paycheck and the first forced withdrawal is what this entire conversation is about. It is a valley in an otherwise elevated lifetime income curve, and it is almost always temporary. Here's a way to actually see the shape of it rather than just hearing it described. Picture someone's taxable income plotted across their entire adult life. It rises through their 30s and 40s, peaks somewhere in their 50s or early 60s when their earning power is highest, and then falls off sharply the moment they stop working. That's the valley. It stays low for a handful of years. And then it climbs again, sometimes steeply, when Social Security switches on and required distributions begin stacking on top of it. Most people assume retirement is a permanent step down in income and therefore a permanent step down in tax rate. It very often isn't. For a household with a substantial traditional retirement balance, the tax rate in their late 70s can be higher than it was at 65, and occasionally higher than it was during their working years. That's the part that catches people off guard. They spent decades being told to defer taxes into retirement because they'd be in a lower bracket then. And for a few years, they genuinely are. Then the forced withdrawals begin and the bracket climbs right back up, often at exactly the moment they have the least flexibility to do anything about it. There's an important caveat worth sitting with before we go further, because the 8-year figure is an illustration, not a rule. The actual length of anyone's window depends on 2 personal variables. The first is when they stop working. Somebody who retires at 62 has a longer runway than someone who works until 70. The second is their birth year, and this is where the difference becomes genuinely dramatic. Someone born in 1959 begins required distributions at 73. Someone born in 1960 doesn't begin until 75. 2 people born a single day apart, and one of them has been handed 2 additional years inside the most valuable planning period of their financial life. If that later group retires in their early 60s, the window isn't 8 years, it can stretch to 12 or 13. That is the longest pre-distribution planning runway that American retirees have had in modern memory. and the people who have it are largely unaware they're holding it. Now let's put a second number next to this, because the size of what's coming is easy to underestimate. Required minimum distributions are calculated by dividing the account balance by a life expectancy factor, published by the tax authority. And that factor shrinks a little every year. In practical terms, the first required withdrawal typically works out to somewhere just under 4% of the balance, and that percentage creeps steadily higher with each passing year. So a household sitting on $1 million in traditional retirement accounts is looking at a first-year forced withdrawal in the neighborhood of $37,000 or $38,000 of newly taxable income. Not requested, not needed necessarily, simply required. And it doesn't arrive alone. It lands on top of Social Security, on top of any pension income, on top of interest and dividends from taxable accounts. The required distribution isn't the household's income that year. It's the layer added to everything else they already had, which means it doesn't get taxed at the bottom of the bracket structure where the low rates live. It gets taxed at the top, at whatever the household's highest applicable rate happens to be. There's a compounding problem hiding underneath this too, and it's the one that turns a manageable situation into an escalating one. The account keeps growing. If a retiree spends the entire gap window doing nothing, the traditional balance doesn't sit still waiting for them. It compounds. $1 million at 65 can easily be $1.5 million by 73, which means the required withdrawal isn't calculated against the balance they were imagining. It's calculated against a considerably larger one, using a percentage that also happens to be rising. The problem grows while the window for solving it shrinks. That's the mechanic that makes this urgent rather than merely interesting. So let's walk through 3 retirees who arrive at the same window with the same balance and handle it 3 different ways, because seeing it play out concretely is far more useful than describing it in the abstract. The first retiree stops working at 65 with roughly $1 million in a traditional 401k. They decide to delay Social Security to 70 to maximize their eventual benefit, which is a perfectly reasonable decision on its own terms. To cover living expenses in the meantime, they draw modestly from a taxable brokerage account. And here's what their tax return looks like for those first 5 years. Almost empty. Very little reportable income. They are sitting in one of the lowest brackets available to them, possibly paying almost nothing at all. It feels like a win. It looks like efficiency. They tell themselves they're being tax smart by keeping their reported income low. Then at 70, Social Security switches on. At 73, the required distributions begin on a balance that has grown to well over $1.5 million. And their taxable income jumps to a level they haven't seen since they were working full-time. They spent 5 years in the lowest brackets of their lifetime reporting almost no income at all, and they never used a single one of them. The second retiree faces exactly the same setup and does something different. Each year during the gap, they deliberately move a portion of that traditional balance into a Roth account, converting it, paying the tax on that amount voluntarily in the current year, and calculating carefully so that the conversion fills up the lower brackets without spilling into the higher ones. They don't convert everything. They don't try to empty the account. They simply top up their taxable income each year to the ceiling of a bracket they're comfortable paying, and stop. Year after year, for 8 consecutive years. It costs them real money in tax at the time, and it feels counterintuitive, because they are volunteering to pay a bill nobody has asked them for yet. But by 73, the traditional balance has been reduced substantially, which means the required distribution calculated against it is far smaller. And the money that moved into the Roth account now grows without ever being taxed again and carries no required distribution of its own for the rest of their life. The third retiree does something narrower, but still meaningful. They don't do conversions at all, but they stop drawing from their taxable brokerage account and instead take voluntary withdrawals from the traditional retirement account during the gap years, deliberately spending down the account that will eventually be forced open anyway. Same living expenses covered. But every dollar they voluntarily withdraw at a low rate now is a dollar that isn't sitting there at 73, generating a required withdrawal at a higher one. It's a quieter strategy than a Roth conversion, and it doesn't produce a tax-free growth bucket at the end, but it addresses the same underlying problem, reducing the size of the balance before the forced distributions are calculated against it. 3 retirees. Same balance, same expenses, same retirement date, and by the time they reach their 80s, meaningfully different lifetime tax bills, meaningfully different required withdrawal amounts, and meaningfully different amounts left behind for whoever inherits the accounts. And this brings us to the thesis of the whole thing, which is worth stating plainly. It was never about how much you saved. It was about which years you paid the tax in. That single reframe changes how the entire retirement picture looks, because most retirement advice is about accumulation, about the size of the number, about whether you have enough. This is a different question entirely. 2 households with identical balances, identical spending, and identical investment returns can hand over dramatically different amounts to the tax authority over 30 years based purely on the sequencing of when income was recognized. Not how much income, when. Let's make that concrete with two households side by side, because this is where the difference stops being theoretical. The first household reaches 73 with a large, entirely untouched traditional balance. Their required distribution arrives every December whether they need it or not. It stacks on top of their Social Security, which pushes a larger portion of that Social Security into taxable territory. The combined income pushes them into a higher bracket than they had planned for. Because their income crossed certain thresholds, their Medicare premiums increase as well, and here's a detail almost nobody sees coming. That increase is calculated based on their tax return from 2 years earlier, so the premium surprise arrives long after the withdrawal that caused it, making the connection between cause and effect almost invisible. And every year the required percentage rises slightly, so the problem doesn't stabilize, it escalates. The second household reaches 73 with a substantially smaller traditional balance, because 8 years of deliberate conversions moved a large portion of it. Their required distribution is modest. A meaningful share of their spending money now comes from a Roth account, which produces no taxable income at all when they draw from it, which means it doesn't push their Social Security into higher taxation and doesn't count against the income thresholds that determine their Medicare premiums. They have something the first household lost permanently: control over what their reported income looks like in any given year. If they need a large sum for a new roof or a medical expense, they can take it from the Roth account without it detonating their tax return. Same starting position, same money. One household spent the gap years and the other spent them deliberately, and the difference compounds across every remaining year of their lives. So what actually goes into that window? Because knowing it's valuable is only useful if you know what to put in it. The largest and most discussed move is the partial Roth conversion. Moving a chosen amount from a traditional account to a Roth account each year, paying ordinary income tax on the converted amount now, in exchange for tax-free growth and tax-free withdrawals later, with no required distributions attached for the rest of the owner's life. The critical word there is partial. The goal is almost never to convert everything at once, because a large single-year conversion can push a household into a high bracket and trigger every threshold problem at the same time. The goal is to convert steadily year after year, filling the low brackets and stopping at the edge. The window is what makes this possible, because it's the only stretch where there's enough empty space in the low brackets to fill. The second move is timing Social Security in coordination with all of this, rather than in isolation. Delaying benefits raises the eventual monthly payment, which is genuinely valuable, but it also serves a second purpose that rarely gets mentioned. Every year Social Security is delayed is a year, with more empty room in the low brackets to run a conversion through. The two decisions are usually made separately by different people at different times. They belong in the same conversation. Third, there's the treatment of long-term capital gains.